Welcome. My name is Van Richards. I'm a chartered financial consultant. And today, the stock that we're talking about is IQVIA. It's kind of interesting because I even had to look it up and see how you pronounce this company. It's been a merger of two companies that were from 2016. We'll talk a little bit more about that today, but I think that you're going to find that the approach that we're taking today is going to be unique, because what I want to do, rather than just give you information on IQVIA, is give you some introduction into how that you can utilize different stocks in portfolios and some of the traits and characteristics that you'll look for in stocks that might have long-term success. So let's go ahead and begin into today with the daily stock analysis. Thanks, everybody, for joining us today. And the first thing that I want to do is tell you that this is brought to you by my firm, which is Richards Financial Planning. And if you're frustrated with your personal finances and you want to try to get them on the right track, go over to my website, which is richardsfinancialplanning.com, and learn more about the prosperous planning process. I think you'll learn a lot and you might be able to take advantage of it. Now, what in the world would I have a picture of a tortoise and a hare for? The idea that I want to introduce you today is a concept that Morningstar uses to strategize for planning for clients. And I'm going to start using this with some of my clients beginning in 2021. The tortoise portfolio is one that has good, strong balance sheets. The hare portfolio, that's H-A-R-E, the little furry animal that's there, is going to be a little bit more aggressive because it's going to try to go a little faster. And I think this is exactly what you're going to look for. It's an investment strategy. Remember that the tortoise has strong balance sheets and the hare has greater potential. Of course, remember, though, don't forget about the mice that's in there, too, because the best laid plans of mice and men can go astray, and there's no guarantees they're going to be associated with the portfolios. But the idea is to look for strong stocks that have great potential. And today, what we're going to do is we're going to go into a company that would be considered one of the holdings in the hare portfolio. That's H-A-R-E, the rabbit portfolio, the one that's going to be a little bit more aggressive. And that is IQVIA. IQVIA is the merger of two companies from 2016. And you're going to find that what they do, I don't really do justice in myself in trying to tell you exactly what they do. So I think that this will give you a little bit better understanding and help you to know what they do. They closed down just a little bit today, but don't take that as a, that it's going to continue in the future. But let's take a look. This is the best part. The net income for the third quarter for this company was up significantly. And what that is pointing toward is the fact that they have a backlog of business that's significant. And we want to take a look a little bit more carefully at the holdings and the balance sheet. But first off, I think that it's really, really important that if you're going to invest in a company, that you have an idea of what they do. And what IQVIA does is that they support clinical trials and research for companies. They work with pharmaceutical companies, biotechnology companies, medical device companies, governments, institutions, foundations, and universities. And they offer them some significant benefits. And this is the reason why that IQVIA is a unique company, in the fact that they allow companies to have faster clinical trials and faster results. They also are able to do cross-study analytics. They may take analytics from one company, the data, and be able to report it for another company. And this particular trait is important to a lot of people. If you're vegan or if you are a vegetarian and you're thinking of investing in a pharmaceutical company, you may not want to do that because they do animal testing. Well, one of the big benefits to IQVIA is that they are able to actually do virtual trials. They just take the data. They don't have to do any type of animal testing associated with it. They are able to do virtual trials, and it actually helps for animal preservation in the long run. They also offer companies the opportunity to have reduced staffing, less infrastructure cost, and that's basically lower overhead. And that feeds right into what I tell all of you every day to follow, and that is look for companies that are stable, have good earnings, and are competitive. Now, when I talk to you about a company and I want you to understand the moat that's associated with that company. And I've talked about a moat a lot, but I think what's important to do is to take a look at the 5 traits that are significant when we're trying to figure out if a company has a moat. Take a look at this. It's that barrier that's between them and their competitors. And here's the 5 traits: network, proprietary effects, cost advantages, switching costs, size advantage. And what we want to do is we want to take a look at what the moat aspects are for IQVIA. And the biggest thing that they have going for them is their proprietary assets. And that's the intangible assets. Those are the things that they are able to do that other companies aren't able to do. Now, they don't have a strict monopoly. There are other research companies, research aggregators that are like IQVIA or similar to it, but they don't have the same data. You'll find that IQVIA is used by just about every pharmaceutical company that's out there because they have such a rich resource of data. The other thing that makes it a significant company is the switching cost. Now, the switching cost that goes along with IQVIA is the fact that if a company is in the middle of trials, they're using data that comes from IQVIA, and they really don't want to switch off because it could affect the end result and the timing of the trials in itself. If we look a little bit more carefully at the balance sheet of the company, we see that the third quarter revenues were at $2.79 billion. A little bit further looking, we go back and we find the third quarter EBITDA, that's the earnings before interest, tax, and depreciations, was at $604 million. Now, when we take a look at this next fact, I mentioned this to you in the very beginning, and this is what makes the future look very promising for IQVIA. It has had some downfalls. Of course, a lot of companies have retreated in their value because of the coronavirus pandemic at the beginning of the year. We're coming out of that. The good thing is that this company has a backlog that grew by 18.5%, and it puts it at $21.7 billion worth of business that they have that's just sitting there waiting to be done in 2021. What IQVIA is saying is that they're looking for revenues in 2021 of between 10.1% and 12.8%. And this rarely happens, but when you look at what analysts like Morningstar are saying, Morningstar is actually echoing just about exactly what IQVIA is saying. They're saying that they think that the revenues for 2021 could be around 12% also. But remember, these are outlooks. These are not guarantees. Now, what do the different analysts say that keep an eye on this particular stock? Number one is it's difficult to replace. You can't really replace the information that they have available to them. Their database of patients is unparalleled in the industry. And then last but not least, it helps institutions to reduce their overall cost, not just the quality of the information, but they help companies, they help pharmaceutical companies, hospitals, universities. We went through all those in the beginning, all of these institutions to reduce their overall cost. Now, all things aren't completely rosy at IQVIA because there are some potential downfalls. There's no guaranteed investment. One big thing that we could see happen with IQVIA is that regulators could decline to approve a particular drug or particular device just if it's based on data rather than actual trials that are geared toward that drug or that device. So the FDA may step in and may offer the decline in price because they won't oversee or allow certain things. The second thing is they have a third division, which is called Contract Sales and Medical Solutions. There's really no moat here. There's no retention, no reason that they're able to keep clients in this. It's one of the smaller aspects of the company, but it does contribute to the bottom line. If you go back, you'll see that it actually had a negative return over the past 3 months, the negative revenue. But it's kind of it's an Achilles heel of the company, because what they're doing essentially is they are basically selling the contracts and medical services of other companies. They're representing them. Now that's probably a bad explanation of it, but that's the way that I look at it, and the reason why it doesn't really stick around. Now, we talked also about law changes that could make data, let's say, more available. The big thing that we see with data privacy is, if data privacy is made more liberal, then there's nothing that makes it proprietary for a company like IQVIA. In other words, it may be data that's available on the open market. Of course, if there's no patient information that's relevant, and that's always a possibility as we go into the future, because who knows what Congress is going to do in the future. Now, if we look at the valuation on this, the fair market value and the current price, it's around 170. When I did this during noontime, it was at 170. It ended at 170.61. But the fair market value that Morningstar's picking on this to make it a 3-star fund is 157. That means it's selling at a little bit of a premium, not too much. But when we look at what other analysts are saying, other analysts are saying that this is they're picking this as a strong buy. Out of 17 analysts that are following this company, and there are a lot of analysts following it, out of 17 analysts, 13 are saying that it's a strong buy. Only 3 of them are saying that it's a hold. When we take a look a little bit further, go back a year and look at what's happened. There are a lot of companies that both you and I know that did not finish the year very well, or aren't finishing the year very well. We've got a few days left in 2020. Oh, won't it be great to be gone? 2021 sounds good. Let's get it going. All right. But a year ago, it was at 146.40. Today, it ended at 169.54. So that's really a return over a period of the year, a yucky year, of 15.81%. That's nothing to sneeze at. It's nothing like Tesla, but it's still a pretty decent return. Now, remember, I told you that this was the conglomeration of 2 different companies. This was the merger of IMS and Quintals, and that was back in 2016. So I went back to 2016 and actually looked at what the price did in that 4+ months in that time period. And that is, let's say, August of 2016, when right before they went through the merger, it was at 71.33, and today again it ended at about, well, when I did this, it was 169.54. It's really at 170.61. But in total, the APR, the annual percentage rate over the 4-year plus time period, is 23.58, a total of 137+% in that time period. And we have to remember, and I stress this especially when we're talking about companies that are a little bit more aggressive, the past performance can't be a guarantee of what the future results is. Now, let's look at what some of the competitors are for IQVIA. Now, when we look at all these different companies like Charles River, Icon, and PRA Health Sciences, all of these companies are mid-cap companies. Even though it's a really big company in the multi-billions, it's still considered a mid-cap company. And when we think of going into the beginning of 2021, there's something that I've talked to you before about called the January effect. And the January effect is an anomaly that occurs sometimes in January, many months in January from the past. When we say many months, many years in the past. The January effect is usually small to mid-cap companies have better months in January than they do throughout the year. There's a lot of speculation on why that is, but it's possible that this company could have a positive outlook just because of the January effect going forward. Now, let's look and see at what some of the analysts are saying about IQVIA. The most, let's say, pessimistic analyst that's out there right now is Piper Sandler, and their analysis came forward in October the 21st, and they're looking at a value between 140 and 179. Remember, the price today was around 170.61. The most, let's say, forward-looking prediction or forecast is coming from UBS Group, and they're looking for the price, a target price between 204 and 224. And that could actually be a really good return from that standpoint. So if we keep in mind, we're still looking for the stability. It is a stable company. Remember, we talked about the Moat aspects of it. The earnings have been pretty consistent, and we know that from the backlog of investments going forward, that this company has a good potential. The competitiveness, if you looked at the spaghetti graph that was on the last slide, you see that it's a very competitive company. So all in all, I think that you see that this is a decent company that will do good going forward. And the whole idea is, when we're going to take a look at this over the next couple of months, or next couple of weeks, actually, I'm going to bring more of the investments that are from the hare portfolio. Now, not the hare, but the HARE, the little rabbit, let's say the tortoise, because we want to look at stocks that are going to have a little bit more aggressiveness towards the beginning of January. I'm a big proponent of the January effect. I think that there's going to be a lot of good things going forward. So, Edward, thanks a lot for your comment. I appreciate that. All right, friends, thanks a lot for the information. This was a short one today. If you have stocks that you'd like to hear about, I know some of you will put them in and I haven't gotten to them, but I can't get to all of them, but I'll get to those that I can. So if you've got a favorite stock, put it in there and let me know, and I'll see if I can follow up on it. And I'm still going to come back to the more stocks from the hare portfolio, HARE, over the next couple of weeks. So you'll see the philosophy, the concepts that Morningstar is using in constructing these types of portfolios. I hope that you gathered something from today. Thanks a lot for joining me, and I will look forward to seeing you later this week, if I can get to the right resource button. All right. Have a good evening.